Good afternoon again. I'm back with the rest of your information on life insurance. It took me a more time than I thought it would to get through the first one and get it uploaded correctly, but we're working on it. It's a process, and we're learning more and more every day. Okay, so back to life insurance. We've talked about homeowners insurance and renters insurance with that. We talked about car insurance. Now let's look at life insurance. And your book talks about 3 different types. So we'll go through those one at a time. First of all, though, let's talk about what's the purpose of life insurance. And of course, it is to help provide for our loved ones if and when we die. We all know we're going to die, but we don't want to leave our families unprotected. So the first thing to consider is how much life insurance do you need? As a young single person, you probably don't need much. You might want to help your family cover expenses of your funeral, because that is an expensive thing. But other than that, if you don't have any debts, you don't have any bills, you don't need to worry so much about that right away. But some of the things that your book says we need to consider about life insurance, let me change this view to the whole view. There we go. Are your present salary, your debts, the things your family has need of, what kind of bills do they have to pay, and the medical expenses that might happen at the time of your death, as well as the funeral costs. A typical funeral in America costs between $6,000 and $12,000. Social Security does give everybody a death benefit when you die, but it is so bad. It is like $255. So it's not going to come anywhere near paying the expenses of a funeral. And then again, as I've already said, if you're single and you don't have any dependents, you really may only want a small policy to help your family cover your funeral expenses. Student loans are forgiven at the time of death. They do not pass on to your loved ones. So if that's the only debt you have, don't let that influence you to go out and buy an expensive policy. Okay, so to calculate death-related expenses, I gave you already the cost of a funeral. Then there are estate taxes, but that usually only plays in if you have an estate valued in the millions of dollars. Medical costs, your hospital stay, that kind of thing. Outstanding debts, and then court costs, which are typically 3 to 7% of the estate that you leave behind. Most of us will live this life. When we die, our estate, the things that we have left over, will pass right on to our family without incurring any great debt. As far as expenses like court costs and stuff like that, unless you want to become a millionaire. Which, I mean, who of us doesn't? All right, so how much do you need? Again, financial maintenance of the family is also important. How much are their monthly expenses? What other income is available? And as I've already mentioned, Social Security, I'll go back to that. If something happens to your family and you experience the death of a parent, until you turn 18, you will be eligible to receive Social Security. Once you turn 18, that benefit stops, even if you're not graduated from high school yet. That's, as the last time I checked, it may have changed since then, because those laws do periodically change. And then, of course, you want to consider how many more years are your children financially dependent on your spouse to provide for them. For example, for me, I have some term life insurance. We'll talk about that in just a minute. Term life insurance ends after a period of years. I think mine was either a 20-year policy or a 30-year policy. But at the end of that policy, I will not renew it, because by that point, my children will be grown. And I only need enough insurance at that point to take care of final expenses. Okay, so the first type of life insurance is term insurance. This is only death protection. You can't borrow from it. It's not an investment in any way, and we'll see how that compares with the others. It's purchased for a set number of years, and then it expires. So typically you buy this for a 20-year policy or a 30-year policy or something like that. It has a beneficiary named on the policy. For example, on mine, my husband is my first beneficiary. Secondary beneficiary would be my children, and they would share it. So if something happened to myself and my husband at the same time, our children would receive that life insurance policies. It does require a payment of a monthly premium. You can sometimes find those that you can pay annually, but it's just easier to pay monthly. And it is the least expensive type of life insurance. Whole life insurance is a little different. Excuse me. The whole life insurance it still has a monthly payment, but that remains the same throughout the owner's lifetime. Excuse me. For example, my husband and I bought a whole life policy when we were very young, so it's relatively inexpensive as compared to what it would be like for us to buy insurance at this point in our life. And a portion of that premium is invested each month to provide additional benefits. So I may have purchased a $30,000 whole life insurance policy, but today it's probably worth closer to $40,000 because I bought it a long time ago. So it has a cash value that I can borrow against if I wanted to, or I can just leave that in there and it will grow with the policy. At some point in my future, it will be paid off, and then I won't have to make monthly payments, but it'll still be there when my family needs that money. And as I said, I can borrow that cash value, for example, to send my children to college or to make a major improvement in my home. Universal life insurance is kind of a hybrid form. It combines parts of term life and parts of whole life. It is permanent in that it doesn't expire, and it has an investment element to it that it will grow in value, but it has lower premiums like the term life insurance. Okay, so those are the three types. Now let's go on to healthcare and disability insurance. We're going to talk about three different categories here: disability, major medical, and hospitalization. And if you catch me watching something else out of the corner of my eye, I have a timer over here so that I don't go too long on my video. So sorry about that. All right, so the first type is disability insurance. This provides money for you to pay your bills if you become disabled and cannot work for an extended period of time. The cost of it is usually goes up depending on several different factors. I'll get into that. But it covers only usually about 60 to 70% of your paycheck, not the full 100% of your paycheck. But it is still an important aspect if you think about it. If you broke your leg or something like that, how would you get back and forth to work? Could you still work and do the job that you have? Usually you have a waiting period of like 3 or 4 weeks or 3 or 4 months, even up to a year before that disability kicks in. And then there are two different types. There's short-term disability and long-term disability. And of course, there's different rates and things affected by that. But it's an important thing, especially if you are an only breadwinner in your house or the dominant breadwinner in your house and your family can't live without your income. Can't succeed without your income. Okay, so major medical is just what it says. It covers all types of medical expenses. It usually has a deductible that you need to meet every year. Sometimes that you have to meet that deductible with every event. For example, if you had a hospitalization, not a hospitalization, that's different, excuse me. If you broke your elbow in March, and then you broke your finger in June, that would be 2 different events, and then you might have a deductible to meet with each event. But most major medical, it's on a year-by-year basis. Hospitalization insurance is just, again, what it says. It pays for hospitalization in every part of it. X-rays, labs, medications, operating rooms, all those kind of things. Usually they have a limit, a lifetime cap on them, and usually a limited number of days per stay, depending on how you purchase your insurance. Most of us get our insurance through our employer, and we'll get that here in just a sec. Okay, so most health insurance is a group health insurance bought through your employer. The bigger your employer, the more people they employ, the better your price is because it's a larger number of people that are contributing to this insurance. Purchasing your own health insurance is much more costly, and it's gotten even worse with Obamacare, but we're not going into that. It's not impossible. It's just really super expensive. So if you are thinking about being an entrepreneur and starting your own business, great. I hope you're healthy. And it's really super expensive, but it's, like I said, it's not impossible. You can do it. All right. And that does it. So thank you for watching. There will be a short quiz to make sure that you watch this. Might just do it as a class discussion. So make sure you take part in that. Thanks a bunch, and I will see you again later.